So all of you all, good evening. Namaste. Welcome to our session today on 29th of April by Committee on Economic, Commercial Laws and Economic Advisory, which is chaired by CA Dr. Rajkumar S. Adukia. The Vice Chairman is CA Hansraj II. And these guys are taking the initiative to get the renowned faculties, and out of which we have got first today presenting on the topic, presentation of receivables as per Schedule 3. We have got CAR Venkata Subramani. Sir, namaste. Welcome to you to this session.
Thank you, sir.
I'll just take a minute to, give a short profile so that we know who is this renowned speaker over here. He's a chartered accountant with over 3 decades of experience who began his career with a professional accounting firm in Chennai. Qualified in the year 1983. He has completed his graduation from Madras. He's engaged in IFRS, AS advisory services for several clients across the globe, specializing in accounting for financial instruments. CA Venkat is currently handling several NBFCs in the valuation of expected credit loss, calculation of loan portfolio, and other financial instruments. He holds a diploma in IFRS from ACCA, UK. He is all India rank holder in both CA, ICWI exams, has an overall experience of more than 35 years. So that's really awesome. You have got, the feathers in your hand, which comes out of a lot of struggle. He's visiting faculty at the Institute of Chartered Accountants of India for INDAS IFRS certificate course for the last 6 years. He conducts specialized courses on financial instruments for participants from regulators, several banks, and corporate entities. So here, this goes to CAR Venkata Subramanian. So please take ahead the session from here. It's all yours, sir.
Thank you, sir. Thanks for the nice introduction. Let me share my screen. Yeah. So I hope you are able to see my screen now, and I'm audible. Yeah. Okay. Thank you. So the topic today that we are going to discuss is about trade receivables. So many people ask what is so different or difficult about trade receivables, right? We have been doing it all along. So is there anything special? Yes, there is something special, and that is the reason why I thought I should cover this today for you guys. And it's always a pleasure to be associated with Institute activities, and especially this continuing professional education, where I know the participation is in large numbers, and I'm extremely happy to share my knowledge with all of you. And every session actually enriches me. So now, as far as trade receivables are concerned, these trade receivables, the reason why I took trade receivables in particular is that many companies and also many chartered accountants have asked me whether we need to provide for the expected credit loss for trade receivables. So now the answer I've been telling is that yes, you have to provide for expected credit loss. And I don't know, about a month back, I took one session for the same CPE where I covered expected credit loss for loan portfolio. Now, I also told that the methodology for ECL computation for loan portfolio is completely different from the one that we use for trade receivables. And so I thought today I will cover in brief at a very, very high level the provisions of expected credit loss as well, because trade receivables without ECL is not there, is nothing. Okay. Now, see the reason why this expected credit loss is introduced is very obvious. The regulators do not want any shock, or rather the stakeholders of any company do not want to see any shock suddenly at some point of time. And instead, they would like to be appraised about the actual status of the collectibles, whether it is a loan portfolio or whether it is a trade receivables, continuously on a continuing basis, so that they know what extent it is recoverable and what extent it is irrecoverable. So that is the whole idea behind this expected credit loss. And it is no-brainer that this expected credit loss is applicable for all types of financial assets. So for every financial asset that is covered, including trade receivables in particular. So the idea is to recognize this credit loss at all times. And now this model is fairly new. The expected credit loss is fairly new for all of us as accountants. Whereas this ECL is not so much new for bankers, because bankers have been dealing with this stuff in the form of Basel requirement. But as accountants, yes, this is new, or I would say it is relatively new, because we have been having this right from the time Ind AS was introduced from 2016 onwards. So, but it is relatively new to us. Now, this is one instance where the loss has to be provided based on a forward-looking macroeconomic parameters. So what we need to consider is all the macroeconomic factors, and based on that we need to find, apart from considering the historical performance of the portfolio, the trade receivables portfolio as well. So this is obviously a expected loss model. Previously, we used to have an incurred loss model. This incurred loss model has been criticized on the grounds that it is too little and too late. So we are now into expected credit loss model, and that is, again, I repeat, is applicable for trade receivables as well. Now, see, in short, the expected credit loss is the present value of all cash shortfalls. Now, cash shortfalls, I'm defining this at a very, very high level, because we're not going into the details of that, except that I'm going to give you some pointers as to how this is to be computed in the context of trade receivables. So cash shortfall is the difference between the actual cash flows, the contractual cash flows, and the actual cash flows, or the actual expected cash flows. Now, as far as ECL is concerned, it is the impairment loss allowance. It's also called as impairment loss allowance. It is measured either as a 12-month loss or for lifetime loss, lifetime expected loss. Now, this lifetime expected loss is applicable where there is a significant increase in credit risk. So whenever the instrument, now in this case it is the receivables, whenever the instrument undergoes a substantial reduction in the quality, in the credit quality, it means that there is a significant increase in the credit risk, and in those cases we need to provide expected credit loss on a lifetime basis. Now, how do you measure the significant increase? Okay. Now, we need not go very deep into this. As a thumb rule, we can say that this SICR is the significant increase in credit risk is measured whenever the credit rating goes down by 2 notches. It's a thumb rule. I mean, it's not defined anywhere. But there is one indication that is given in the standard, which is if the days past due exceeds 30, that means if the DPD exceeds 30, then you can say that the credit risk has increased significantly. Now, the next one is where it actually gets credit impaired or defaulted. You can call it as defaulted or credit impaired. Again, there is no definition for this term. So we need to go by what is used by the management for their internal credit control. And we also have to apply qualitative factors to examine whether there is whether the instrument has actually defaulted. Again, the yardstick that is given in the standard is also the same as what is provided by our regulator for banks, which is RBI, for defining what is called as a non-performing asset, so which is 90 days. So if the receivables exceed 90 days past due, then you can say that it is defaulted or credit impaired. Now this is the general one. So there are a lot of other qualitative indicators which can also point towards a deterioration in the credit quality to such extent that it can be called as credit impaired. Some of those are the significant financial difficulty of the issuer, breach of contract, all those things are there, which I have given here. So whenever these things happen, we can say that it is credit impaired. Now let us come to the trade receivables part. Now this overview, we just saw the overview. Now here As far as the trade receivables are concerned, we all know that the receivables has a lifespan of normally less than 6 months or at the most 1 year, right? 6 months to 1 year. So you will have to obviously collect your trade receivables within a period of less than 1 year. So there is nothing like a long-term contract, unlike a financial instrument. Let us say in the case of a loan, where if it is a mortgage loan, you expect to receive the cash flows over a period of say 10 years or even up to 30 years. Whereas in this case, the trade receivables, you are supposed to receive at a very, very short notice, at a very, very shorter period of time as compared to the loan portfolio. So the computation of the credit, computation of significant increase in credit risk becomes somewhat difficult for trade receivables, because that line is very, very thin, because the total period of collection itself is very less. I'm just giving you the background as to why we have this kind of a special treatment for receivables in place. That is the background or the basis for concluding why a special treatment is given for trade receivables. So for trade receivables, the company, the entity, need not follow what is called as the general approach. So whatever we saw now, the bird's eye view of expected credit loss, is as to how the expected credit loss is computed for a loan portfolio, which is also called as the general approach. Whereas for trade receivables, there is a special treatment, and that treatment is called simplified approach. So you are given a simplified approach. You don't have to find out whether the credit risk has increased significantly from the inception date. There is no need to compute all that, which means it is a simplified approach. Now, you'll be surprised to note that this simplified approach has to be followed for trade receivables. In other words, you don't have a choice. You can't say, I will follow the general approach. You don't have that choice. So for a trade receivable, what you're supposed to follow is what is called as the simplified approach and not the general approach. However, if the trade receivable has a significant financing component, so there is a significant financing component, then you have a policy choice. It is actually an accounting policy choice which you can exercise by following either the general approach or the simplified approach. So you have a choice. So because if there is a financing component, it will be akin to the instrument, can be called to some extent like a loan portfolio. Because for loan portfolio, I said already that the approach should be the general approach. Simplified approach is not allowed for the loan portfolio. So if a trade receivable has a significant financing component, then you have an accounting policy choice. Only if it is a trade receivable, you have an accounting policy choice, whether you want to follow the general approach or the simplified approach. Again, for lease receivables, you also have this choice, this choice, whether you want to follow the general approach or simplified approach, irrespective of whether there is, obviously there is no financing component there. So for lease receivables, it is specifically provided. Now so now we are going to see what is meant by this simplified approach. So we will see the characteristics of simplified approach, how to work on the simplified approach. Now, let us get into Schedule 3. Now, Schedule 3 gives you this table. Now, let us take a minute to understand the components of this table, because this is the table that is given in the schedule, and it says that the outstanding has to be bifurcated based on the aging. This is a new requirement, so based on the aging. So it is less than 6 months, 6 months to 1 year. Previously, the aging was much shorter duration. Now we have a long list. So less than 6 months, 6 months to 1 year, 1 to 2 years, 2 to 3 years, more than 3 years, and the total. Okay. So that means you have to bifurcate the receivables based on the aging of the receivable. Now, what is meant by aging? So, aging is the number of days that has passed from the date on which the trade receivable is collectible. That is, from the date on which the customer is supposed to pay you. So, when is the customer supposed to pay you? The customer is supposed to pay you not from the date of the invoice, but from the date on which the credit period expires. Supposing you are giving a customer 45 days credit, then the meter starts only on the expiry of the 45 days. So this should be explicitly stated, which means for each customer, you will explicitly state in your policy whenever you raise the invoice that the amount is payable after 45 days or the amount is payable after a period of 60 days or whatever. Right? But if there is no such contract, there is no such written communication, there is no such communication, either written or based on the practice or whatever, then the meter starts from the date of the transaction. That is, the date of the transaction is the date of invoice. So you have to compute. So it is not a generic number of days that you will compute. You will compute specifically the outstanding, the aging, based on the credit period for each and individual customer. Normally, supposing, let us assume there is a wholesale customer or a retail customer. For wholesale customer, probably the credit period could be 3 months, that is 90 days. And for retail customers, it could be just 30 days. So you will have to reckon the receivables, the meter starts only from the date on which the customer is supposed to pay you and not from the date of invoice. Now, these are the classifications that are required, which means there is an undisputed trade receivables, considered good, undisputed trade receivables, which have significant increase in credit risk. Okay. Now, undisputed trade receivables, credit impact, disputed trade receivables considered good, disputed trade receivables which have a significant increase in credit risk, disputed trade receivables, credit impact. Now, please note that as far as these line items, which are the credit significant increase in credit risk or credit impact, these things are concerned, these things are applicable only where the company chooses or the company elects to follow the general approach and not the simplified approach, and only in those cases where the receivables contain significant component, financing component. Okay. Let's move on. Okay. Now, so the sub-classification is considered good secured, considered good unsecured, trade receivables which have significant increase in credit risk, impact, etc. Okay. Allowance for bad and doubtful debts should be disclosed separately. Then debts due by directors or officers, either severally or jointly, all those things, should be separately stated. Okay. These are sub-classifications. Now, here, this is very important to know. What can be considered as trade receivable? So there is a clear-cut thing. I mean, it's a generic rule. It's not specific to this. It's a generic rule. So the unbilled dues should be disclosed separately. Trade receivable should be the amount due on account of the goods sold or services rendered in the normal course of business. That means it cannot have any other dues other than on account of selling goods or services. So, for example, there are some examples are given here. So, if it is the amount due under any contractual rights other than arising out of sale of goods or rendering services, it cannot be included in trade receivables. Instead, it should be included under other financial assets. So some of the examples which will be coming under other financial assets are insurance claims, receivables from insurance claims, sale of property PPE, or contractual reimbursable expenses. Some of the examples are given here, but only those which arise on account of sale of goods or services should be part of your trade receivable. Then Now, the impairment requirements are based on forward-looking expected credit loss model. Okay. Now, we will see a little bit later about the forward-looking model, etc. But right now, what we already saw, I have explained to you more than once, is that there are basically two approaches. One approach is called the general approach. The other one is called the simplified approach. So in the general approach, the credit exposure for which there has not been a significant increase in credit risk since initial recognition, it is also called as stage 1 assets. These are called as stage 1 assets. The second one are those where there is an SICR has happened, which means there is a significant increase in credit risk has already happened. That forms the stage 2 category. And the third one is where it is already defaulted or whether it is already credit impaired. Now, these three are applicable only where there is a significant financing component and where the entity has decided or elected the accounting policy choice to implement the general approach. So if there is no significant financing component, then there is no accounting policy choice other than to follow the simplified approach. Here in the simplified approach, the entity does not separately track changes in the credit risk, which means you will not have anything called SICR. Okay, but there will be something called credit impact. So this is what is called as the purchased or originated credit impaired asset. That is, at the time of purchase itself, the asset is credit impaired, and that's what comes under this, under the fourth category. Okay. Now, let us look at this one. Now, this trade receivables that do not contain significant financing component, the requirement is to apply simplified approach. I have explained the first two parts. Now, very interesting point is that the standard provides a practical expedient. This practical expedient is that you can use what is called as a provision matrix method. Now, whenever you see this provision matrix method, everybody jumps out of joy. They think that, oh, if provision matrix is applicable, I don't have to do any complex calculations. I can simply use a provision method by which you say, okay, it is less than 1 month, 0.2%. Between 1 month to 6 months, 1%. 6 months to 1 year, say 3%. Above 1 year, maybe 10%. Something like that. Ad hoc provision. That is prohibited. That is not allowed. So the provision matrix method also should cover, specifically given that the provision matrix method should be based on probability weighted outcome, the time value of money, and the reasonable and supportable information at the reporting date about the past events, that is the historical performance, the current conditions, and forecast of future economic conditions, which means all the ingredients, please note, all the ingredients that are required for the purpose of computing expected credit loss for a loan portfolio is automatically included in this, is automatically covered, is automatically included in this one. So that means that when you take care of this one, you cannot simply make use of the provision matrix by having an ad hoc number. So it has to be based on what? It has to be based on the historical loss, adjusted for historical losses. What historical loss is based on the past data, the recoverable data, or the historical performance, adjusted for the future macroeconomic data, which is forward-looking data. So which means all the ingredients are coming into play here. But I will tell you how this can be done for the trade receivables shortly. I will tell you how this is done. Okay, and how the simplified approach can effectively cover these things without much difficulty. Now, so I think this is just a explanation of the same thing. So if the company chooses to calculate the credit impairment under the general approach, if it is the general approach, then you need to have the breakup of significant increase in credit risk and the credit impaired. So otherwise, and okay, one important point is that the loss allowance is deducted totally. That means there is only one line item, and the carrying value is not altered. See, the loss allowance is provided separately without adjusting the carrying value. Okay. Now, for the impairment allowance, so this is mentioned here very clearly for the presentation. The impairment loss allowance is not reduced from the carrying amount. Instead, it is shown as a deduction as a single line item. So based on whatever will be the category, the loss allowance is deducted as a single item. Okay. But if it is a purchased or originated credit impaired asset, so normally, see, these are used for trading purposes. You buy and sell. Okay. So if it is a credit impaired trade receivable, then you have to adjust the lifetime. It is always lifetime credit ECL is provided on those. Lifetime credit ECL is provided, and for that the carrying amount is reduced. So that is the basic difference between these two. So for POCI, POCI assets alone, POCI trade receivables alone, the carrying value is reduced, and for the regular trade receivables, it is shown as a loss allowance, which means that the loss allowance keeps fluctuating year after year. So the next year you reverse this and pass a new entry for the new allowance. Now, so SICR, I think we have already covered this one. So I have explained this to you already. So this SICR, then credit impaired, the credit impaired and the good items. So good is the residual class, which means either it is credit impaired or SICR. If it is none of these two, then the residual class is what is called as the good ones. So that is how it is computed. Again, this is presented as a separate line item, and only for those for which there is a significant financing component. Now the individual assessment. See, again, this one, if you can do the ECL either on individual receivable basis or as a portfolio as a whole. So if you decide to do it on an individual basis, then you will have the significant increase in credit risk. All the stuff will come. So accordingly, the presentation will be made based on that. Okay. So the same thing. Now, okay. So when a company has assessed the credit risk on an individual basis, with respect to the recognition of loss allowance, it is recommended that the company should disclose the following. So the following footnote is recommended: amount of trade receivables for which the company has assessed the credit risk on an individual basis, and those for which it has done on a group basis or on a portfolio basis. So the bifurcation is required because so that the readers will know where the credit risk is assessed on an individual basis and where it is done at the portfolio level. Okay. Now, see, aging of trade receivables. We saw the aging. Now, the explanatory note that our institute has provided the guidance. They have provided the guidance on this. It's a wonderful publication. So there they are suggesting that you add two additional columns with the heading unbilled and the heading not due. Okay. So what you have is less than 6 months. Of course, less than 6 months probably will cover not due. But as a matter of abundant caution, if you add unbilled and not due, then it will help you to tally the total amount of receivables. So unbilled also should be included because the entity could have an unconditional right to consideration before it invoices its customers in case it records an unbilled receivable. So for example, this could occur where the entity has satisfied its performance obligations as per Ind AS 115, but has not yet issued the invoice. So better for the purpose of reconciliation, you can add these two additional columns. Now, this I have explained already, how to reckon the due date. The due date, how to reckon the aging, the number of days of aging. You will actually compute the number of days from the due date. So which means for individual customer, you need to find out what is the due date that is applicable. Okay. It is also likely that for some invoices for the same customer, Okay, for some items, for some category of items, you may give more credit period and shorter credit period for some other items. So that is also possible. So those things I think you'll have to consider. So I think, it goes without saying that you should have a proper EDP system, proper accounting system, which takes care of these due dates calculations properly. So if there is no such specific due date, then the aging schedule starts right from the date of the transaction. Okay. So disputed, undisputed, I think it's more common sense basis. So what is disputed? So if it is again a matter of facts and circumstances. So dispute means disagreement. So dispute, again, one very important factor is that just because it is disputed doesn't mean that the credit risk has increased significantly. It doesn't mean that. Okay, there is a genuine dispute. So a dispute might not always be an indicator of the counterparty's credit risk and vice versa. Okay, so but just that that you have to basically consider the disputed and undisputed should be shown separately. Okay. Okay. Now let's move on. Now let us see the simplified approach. Okay. What are the steps in doing the simplified approach? Okay, this is based on a practical thing. See, the first step is what is called as the grouping. Now, you have trade receivables for different segments, okay, different types of trade receivables. The first step is to group it. Appropriate grouping you have to have. Okay, that grouping should consider the similar credit risk characteristics should be considered, and it should be aggregated. Like, for example, you have two segments. Okay, one segment for wholesale, another for retail. Then the behavior pattern of the historical collection pattern of the wholesale customers may be different from the retail customers. So you will have to group it separately. Now, this is very, very important, because if you do not properly group based on the similar credit risk characteristics, right, you will get some absurd results. So if the grouping is based on dissimilar credit characteristics, then you will get absurd results. So this is very, very important. Again, the grouping should be at an ideal level. It can't be too great. It can't be too granular, nor can it be at a very high level. For example, you can have only one group for all the trade receivables. That's not possible. At the same time, you can have one group for each individual customer. That again is very granular. You won't get any result. So this is something that has to be applied properly. Okay, this is very important. The second one is determine the period over which the historical rates are appropriate. So this is also called as the analysis period. So you need to find out. So what is the exercise? The exercise is we are trying to find out what is the historical loss rate. What is the historical loss rate? So if you have to find out the historical loss rate, obviously you need to know what is the historical loss that you have incurred, or you can also find out what is the amount of loss given default that you are likely to incur. Both are historical losses only. Let me repeat. You can find out straight away the historical loss that you have incurred in the past, or we can also, based on the experience, you can find out if it gets defaulted, what is the likely. So defaulted means, so you may define the default in this case to be after a particular number of days. So if it exceeds a particular number of days, you may say that it is defaulted. And if it gets defaulted, you can say you can compute what would be the loss given such a default. So that can also be considered as a historical loss. Okay. Now, this has to be computed for what? This has to be computed for a defined period of time in the past, which is called as the analysis period. Now, this analysis period is very, very important. This analysis period can't be the last 25 years. It can't be. It can't be the last 2 years, because obviously, the last 2 years has been affected adversely on account of the COVID behavior, right? So you can't take this to be the ideal period for consideration. So you may have to probably include some period where there is a normal line of business. So usually about 2 to 5 years is considered to be the normal. So some chat. the trade receivables aging based on FIFO method for convenience purposes and disclose the methodology by way of note. Trade receivable aging based on FIFO. Okay. Now I think I guess my understanding of your question is that supposing you have one customer, this customer pays you. Now there are two billings, right? One billing for 5,000 rupees, another billing for say 6,000, and this customer pays you 7,000. How would you adjust? So first 5,000 will adjust, the second 2,000 will adjust against second bill. Is that what your question is? If that is your question, okay. Now that is by default that you have to do based on the contract act, okay? Because the appropriation is done based on first in first out. If there is no specific methodology that is given by the payer, the payer says appropriate it against the second invoice, don't appropriate it against the first invoice, then you are supposed to obey that. But if it's silent, then obviously it will be based on first in first out only. Okay, I don't know whether that's what you mean here, because that is got nothing to do with ours. I don't know. Am I right in assuming your question? Sorry if I misunderstood. Please repeat it in different wordings so that I'm able to answer. In the meanwhile, I will proceed. Okay. Now, so the step 2 is to find out the ideal analysis period. So second, very, very important. What is the ideal analysis period? Then the third step is find out the historical loss rate. So you have identified the loss. You have also identified the historical loss period or the analysis period. Find out the loss rates. So determine the loss rates for each of the group. That means for each of the bucket. So you ideally you bucket it based on 30-day buckets. So less than 0 days, 1 to 30 days, and so on. So like that you bucket it, find out the loss rates for each of the bucket. Then now this is the place where you consider forward-looking macroeconomic factors. So now what you have, you already have the historical loss percentage. Now you need to find out the macroeconomic factors that are likely to impact your collectability. Please understand this very carefully. See, for each and individual economy, like for example in India, or if you take the case of Oman or any country for that matter, the Economist Intelligence Unit or Bloomberg or any such data provider, they provide 300 variables, macroeconomic variables or macroeconomic factors relating to the economy, to the country. Okay, not all of these will be relevant. So we have to find out which are the macroeconomic factors that are relevant, and based on that you consider those. I will give you a very small example how this is to be completed a little while from now. Okay, let us complete this. Then find out the expected credit loss. The expected credit loss is calculated by multiplying the current gross receivable by the adjusted loss rate. So based on the macroeconomic factors, you have to adjust the historical loss, apply that. Then should be for each group apply that for age for each group. Okay. Now calculate the expected credit loss. Then create two scenarios. Now, what is the benefit of this? What is the advantage of considering this macroeconomic factors? Is that macroeconomic factors is going to tell you what would be the additional scenarios be like. So whether the additional scenarios are going to show towards increase in default, or whether it is going to point to decrease in default, or both the scenarios may point to increase in default or decrease in default. So there is no such rule that one scenario should be pessimistic scenario, another scenario should be optimistic scenario. Nowhere in the standard is mentioned like that. You have to consider a minimum of 3 scenarios. So one, there is a base scenario. The other 2 scenarios have to be considered depending upon the answer what you get by considering the macroeconomic factors. Depending upon the macroeconomic factors, you may get different results. In some periods, I have seen, for live cases, I have seen sometimes when the economy is already on the lowest ebb, then there may be a slight turnaround, and both the additional scenarios may point to a reduction in the defaults, and sometimes both these may point to an increase in defaults. Okay, so whatever may be the thing, apply that and apply a suitable probability weight for that. It is ideal to consider or to give the maximum weight for the current scenario, which is called as the base scenario, and for the additional two scenarios to give equal weight, because we don't know what is going to what scenario would be the more likely outcome. So assign equal probability to the remaining two scenarios, which means if you allocate 40% for the base scenario, the remaining 60 you can allocate 30% each for the other two scenarios, and then find out the probability weighted expected credit loss. Okay, so that is how it is done. Now I have given some sample. Okay, so here let me so this is based on the actual in the sense that based on some numbers, and these whatever you see here, the percentages is all the numbers based on the loss whichever has been written off. Okay, now the write-off, there is a 7 lakh write-off, and these are the total sales. Okay, now the total sales in the past 5 years, this is the total sales. Okay, and out of this total sales, this much is collected when it is in not due itself, and this much is collected within 1 to 30 days, and so on. So find out the percentage of the 7 lakhs on the balance of the respective buckets and call that as the historical loss percentage. So this is the percent. So what all we have found out what is the sample period or the analysis period. Now the analysis period is 5 years. And the loss we have found out, the historical loss, this is actual historical loss that is experienced in the last 5 years. And this is the collection pattern, or this is the historical performance of collection. Okay, so based on this, I find out what is the percentage of loss. This is the historical loss percentage. Okay, now please look at this number very carefully. This 21 crores, whatever, so this is the whatever is the balance. Now the balance is 1 crore 30 lakhs is the balance. Now this balance, I have kept the same balance, but only the collection is different. The performance is different. So if the performance is different, obviously your expected credit loss will also be different. Okay, that is what I wanted to prove here. So here the first one is find out the loss percentage. What I have done is to find out the loss percentage, then apply the loss percentage for the various scenarios. Okay, so there is a bump up and bump down. So I have bumped up and bumped down based on the factors. So I said it is 1.2. This is what I have shown here. So the multiplier is 1.2 and 0.92 is what I have got. Okay, this is obtained based on the analysis of macroeconomic factors. I will explain how to find out this bump up and bump down percentage. Now I have applied that, and based on that, I have arrived at the additional two scenarios: base scenario, scenario 1 and scenario 2, for the bumped up scenario and bumped down scenario, and applied the probability weight for those. And I have found out the weighted average ECL for this. So this is the answer for this 3,45,000 is the answer for the ECL for the particular segment called wholesale. Now out of the company, there are two segments. One segment is wholesale. Okay. Now I told you the same balance. Look at the same balance here. This 1 crore 30 lakhs is the same balance. Okay. This is the number that you're getting. So I have the same number, but the collection performance is completely different here. The collection performance is different, based on which you can see that this percentage of the historical loss is different. Historical loss is also the same. Please understand what are all common. The balance is common. The receivable balance is common. The historical loss is the same. What has changed is the collection pattern or the performance, the collection. So within how many days you are able to collect. Okay, that is what has changed. Now, because of that, you find that this percentage, loss percentage, will vary. Now, applying this one, applying the same bump up and bump down, I'm arriving at this 2,94,000 in another case. Okay. So, which means the performance, what I want to prove here is that the collection performance will have a bearing on your expected credit loss. So let me go back to the first screen. So here the expected credit loss is 3,45,000 for the same amount of receivables. For the same amount of I have not changed the receivables number. I have not changed the loss, the loss as well. Okay, the historical loss suffered also I have not changed. But what has changed is the performance, the collection performance. So in one case, it is coming to 3,45,000. In another case, it is coming to only 2,94,000. So that means there will be a significant variation. So what is important is you need to track the performance, how you are able to, so this sheet is very important. How you are able to collect, this tells you what would be the balance, and accordingly, the historical loss percentage will vary. Okay. Now again, I can't apply this for another segment, which is the retail segment. So for retail segment, I will have to do the same thing. Now this is retail, so I have to do the same stuff there. Okay. For retail, so I find out how much is the number. Okay. So in one case, it is coming to 1,21,000. I have assumed the same number, same receivable, same historical loss, but collection is different. So I have used different numbers. Based on that, you find that this ECL number is also different. So just to prove that this has a significant impact on your ECL based on it. Okay. Now, the last thing which I want to cover, I think I have 15 minutes. What I will do is I will take another probably 7 minutes to cover how to build the scenarios. Okay. And then I can take some questions. Okay. Now, this scenario building is for what? It is for considering the macroeconomic factors. Now, what you are trying to find out is you are trying to find out whether there is a significant correlation which will be accepted statistically, whether there is a statistically acceptable correlation between the independent variable and the dependent variable. Now, the dependent variable are the loan receivable, that is the loan receivable or the trade receivable, whatever may be the case. Okay. Now, in this case, it is trade receivable. So the trade receivables are the dependent variable. It depends on what? It depends on certain external macroeconomic factors. It could be inflation. It could be GDP growth rate. It could be the risk-free rate. It could be the oil price. It could be, whatever. It depends upon the industry. Whatever industry we are looking at, we need to see. We can take a bunch of macroeconomic factors. We can take even up to 10 different factors. Then we need to run what is called as a multivariate regression analysis. Okay, this multivariate regression analysis will tell you whether there is a statistically significant correlation between the dependent variable and the independent variable by examining the test. There are various tests like R-squared test and p-value. So if all these are passed, if these passes, then you will get what is called as the intercept and slope. Now with this intercept and slope, you have to apply the equation y is equal to mx plus c. So where y is the dependent variable, x is the independent variable, and m is the independent variable of the slope of the independent variable, and c is the intercept. C is the intercept. So apply this formula y is equal to mx plus c and arrive at the two more scenarios. Okay, and based on these two scenarios, you find out what is the bump up and bump down. Okay, now I have given some practical, numbers, some example I have given here. So here, what I have done is I have taken the macroeconomic indicators. So I have considered GDP, inflation, and risk-free rate, and the time periods are quarterly time periods. I'm doing this for the last several quarters, starting from March 2015 onwards. So March 2015, every quarter, I have taken the GDP growth rate. Okay, you can see during COVID time, it is actually fallen. These are actual data taken from the Economist Intelligence Unit, which again is an open source. It is free. You can take it from there. So you have the inflation and the risk-free rate. Then based on this, you find out the this is the dependent variable. So I'm finding out the dependent variable is nothing but your receivables balance. So these are the percentage of the receivables that are not yet defaulted. That is, you define whatever will be the default, you try to find out. Based on that, you run the regression. Your regression statistics looks something like this. Okay, so here you have this is multivariate regression. So you have the R square test. So this R square should be greater than at least 75% or 70% should be greater than 60 or 70. So now it is 0.78, which means R square is passing. Then the p-value should be less than 0.05, so it passes on all this. Then you get what is called as the intercept and the slope. So these two are the slope for the inflation, slope for the GDP, and the intercept. Based on this, you arrive at these two scenarios. Now, these are the two additional scenarios that I have arrived, and which translates into a bump up and bump down. So this actually translates, you'll be surprised to see that this translates to two rosy pictures. This time, it points to a decrease in default. So both the scenarios points to a decrease in default. One scenario is 14%, another scenario is about 24% decrease in the default. So that is how you arrive at this one. Okay. So this risk-free rate, there is no impact. So this risk-free rate, I am not considering because it has not passed the statistical test. Okay, how and who will decide the disputed, undisputed? No, I don't think there is any this thing. It's more based on the facts and circumstances. There is nobody to decide. So you have correspondence to that effect that there is some dispute. Then obviously it is disputed. I think it is more based on the facts and circumstances of the case. So I think with that my presentation on this one is complete. If you have any questions, I'm willing to take, because I've given you a bird's eye view of the significance of this trade receivables. Any questions, sir?
So there are two questions in the chat box. I think you have tried to attend the first one, but there was some challenge in that.
No. First one, I told the answer, but I don't know whether the question I have understood correctly. So I wanted the participant to redraft the question in some other thing. What I understand is, can we prepare the trade receivables aging based on the FIFO method for convenience? There is no convenience. It's actually FIFO method is what is normally applied. It's not for convenience. It is what is applied unless the customer specifically tells you adjust this against this particular invoice. Then you have no choice other than to adjust it. Otherwise, it is done on a FIFO basis. Even from a legal point of view, contractually legal point of view, also it is adjusted like that only. That is what the law says.
That looks great, sir. So anything in a nutshell, if you want to wrap this up, because we just have two questions. And I think your flow is going great. So basically, since we are understanding it more better, so obviously the deliberations would be less that would come across. So in a nutshell, if you want to wrap something and advise something to the fraternity pertaining to practice in this particular field.
Yeah. See, one thing is, I started this discussion with this one, that you have to compute expected credit loss for trade receivables as well, because there is a credit risk associated with this. It is not as if it is there. And in fact, I have also received the questions relating to whether we need to provide ECL for receivables from government. Yes, you have to provide. There's no two ways about it. You have to provide. Okay. Just because it has to be, you have to receive it from the government, doesn't mean there is no credit risk associated with it. Okay. The 109 specifically tells even sovereign debt you are supposed to have, there will be some risk associated even with the sovereign debt. Okay. So when you have that, obviously for receivables also there will be credit risk. So one thing is that it is a must. The second one is that you need proper configuration in your EDP system. The client should be sensitized to calculate the aging in a proper way. Okay, the aging should be done based on the the date on which it is actually due and not based on the transaction date or the invoice date. That should be sensitized, and then to find out how it is to be done. And also please do consider the two additional scenarios. So these two additional scenarios, if the regression test fails for whatever may be the reason, many cases the regression test also fails. It is not as if it will pass, but if it fails, then you can use your judgment and say, okay, because the regression test passed but it fails, I want to use the bump up of say 10% and bump down of say 5% or whatever, depending upon the situation. Today we can say that, the corona, all the waves are over, but still there is some fourth wave lingering at some parts of the country. Okay. So you may want to say, I will take a bump down of only 5% and I will say a bump up. That means I expect the default to go up by 10%. I may expect the default to come down by only 5%. These are the two things which you have to apply your judgment for this one. But one thing is for sure, that unless you have these three scenarios put in properly with the proper judgment, because it is not a rocket science. It is not, you don't need a PhD or a Nobel laureate to compute this one. It is just simple common sense. And if so long as you do that, you will be conforming to the requirements of the Companies Act. Okay. So I think that's what is relevant there. Net of bad and doubtful debts. Okay. See this bad and doubtful debts. Okay. The bad and doubtful debts. Okay. Bad means obviously if you have written off, you have written off. Okay. If it is not written off, it is part of your receivables. Okay. So that bad and doubtful debts is provided for the non-Ind AS. So we have a provision. We have a provision for bad and doubtful debts. But here there is no provision for bad and doubtful debts. We call it as what? We call it as expected credit loss, and there is a scientific method by which you compute expected credit loss, as I have explained to you. Multiple contracts with the customer and the advance given on ad hoc basis. Can we adjust advances based on FIFO basis and show the trade receivable aging? Okay, see, all these questions are you have to apply judgment. Okay, I'm not there because you need to know further details. You need to have further details as to the facts and circumstances of the case. Okay, so what is the advance for? Okay, can it be appropriated? What is the law? What is the terms? If it can be appropriated or it is just kept as a deposit, then you can't do all those things, right? So it depends. So it can be adjusted against your ECL if it is kept as a security deposit or something like that, right? So I think this depends upon the facts and circumstances. ECL is applicable to total outstanding. What about doubtful? That's precisely what I said now. Okay. So this doubtful debts. What do you mean by doubtful? So you are doubtful about collection, right? So that is your bad is you're not going to get. So it's as good as written off. That is part of your historical loss. So if you say it is bad, it means that you have to treat it as a loss given default. So if it is defaulted, you are not going to collect it, right? So it is part of your historical loss. You get my point? So if it is doubtful, that is what we are trying to find out. So doubtful means what? You are apprehending that the credit risk on this is so high that you may or may not be able to collect, or more likely you may not be able to collect. That is your apprehension, right? That is what is reflected in our thing, in our computation indirectly. So did I answer your question?
Yes, you have answered so all the questions that has come across over here, and very nicely when you explain things in a nutshell, and we could retain it more easily. And thanks, you shared your contact details as you did last time also, so that if the members, the participants over here, they want to get through you or touch you, they can definitely do that. So on behalf of the entire Committee on Economic, Commercial Laws and Economic Advisory, I thank you, sir, CA R. Venkata Subramani, for putting in your time and coming on this eve and enlightening us with your knowledge and also guiding us. And we are looking forward for much more sessions with different topics coming up from your end, sir.
Sure, sir. Thank you for the opportunity. I really appreciate that.
I'm extending the thanks from our chairman, sir, CA Dr. Adukia, as well as the vice chairman, CA Hansrastu. And thank you so much, sir. Thank you.
Thank you. Thanks. Thank you.
Saran, sir, are you there? Sir, good evening. Sir, you're on mute, sir. Sir, you're on mute.
Yeah. Sir, call me Saransh, please. Yes.
So Saransh means So you have to explain your name. I know it, but I won't hear it.
So in short, I in English you can call me a summary.
So it means something that is full of lot, but looks tiny, looks small.
Yes, sir. Yes, sir.
So that's it. And this name has good weightage. Like it means something in a nutshell. Like when you open it, it will keep on opening. It will keep on opening. It will never end.
Hopefully today's session gives the same impact.
That will be there. So I'll just introduce you to my participants over here, the members who are here. The short profile of CA Sharaj Day. He has completed his law degree. He's a law graduate from one of the best colleges in India, ILS, Indian Law Society, Pune, and has hold a bachelor's in commerce from Symbiosis. So nice. He has done his master's in business administration from Indian Institute of Management, Kozhikode. Wow. Being one of the youngest candidate ever to be admitted to the course and was part of an elite 180. Superb. He has 12 plus years of experience and have played active roles in setting up businesses for his employers, ranging from dairy, newspaper, magazine, non-banking financial company, construction, real estate, gym, franchises, NGOs, etc., etc. He is a visiting faculty at Symbiosis College of Arts and Commerce. So what you have gained from there, you're returning it back to them.
Trying my best, sir.
His core focus is real estate with end-to-end management of clients. He's here to talk about real estate, understanding the power of IRR acquisitions. So, sir, please enlighten us with your knowledge, and let us also get into the depth of Saransh and understand it. All yours to you, sir.
Thank you, Salim, sir. Thank you. Thank you. Krishnan, would you be sharing the presentation or should I do it?
So you're co-hosted, so you can go ahead.
I can go. I've kept our presentation a bit simple. I want our members to understand the role that we can play in acquisition of real estate sites and what developers expect out of us. The role that we play nowadays has drastically changed. From merely looking at numbers or raising finance, now developers are looking at us as a one-stop solution to give them a go, no-go decision in new acquisition in real estate. That is the role that most of my peers have translated into. And now developers look up to chartered accountants to direct them whether an investment is sound or not. Now, why our objective or what our subject for today's discussion was IRR and acquisition. I want us to go back to basics and understand what we need to look at the time of real estate acquisitions. Now, these rules are universally applicable. You can apply it in any other industry by applying the same rules that we will discuss today. But why I picked up real estate is one, most of our practicing members have some touch base with either one or the odd real estate client. That has been my experience. And two, real estate per se is universally spread across India, and these rules can be applied in each micro market where our members are catering. So the objective was to share my experiences of what has worked in past 12 years and what has not worked, and what some real estate developers are doing very well, which is leading them to grow at an exponential rate, and what some developers who had succeeded at a different level have forgotten basics and unfortunately have even got into IBC and insolvency. So my objective as a CA in this presentation would be to just give you a brief understanding on what role we can play. What has translated nowadays is when a developer or when a client looks at acquisition of new real estate sites. Previously, if you go 5 years, 7 years before, the only discussion they used to have was with their architect, who used to give them a total potential calculation, tell them that this is the saleable that you can construct on it, and the developers used to take a call based on their own understanding and enter into sites. What has now translated is developers have wisened up. Most of the developers in Pune, Mumbai, Bangalore know that the upfront investment, the sales velocity, the product that they design has a huge impact on how they generate returns on their investment and profits to their shareholders. And for achieving those, what needs to be taken care of, that most real estate developers have become mindful of. Again, why I use the word mindful? Their decision may or may not change based on your analysis, but at least they can take certain corrective measures or certain corrective actions based on your input during the stage of acquisition. So let's begin. For members who are not aware of real estate as a whole, I have started with brief points on let's understand the type of proposals that a real estate developer gets. Broadly, they are of 4 types. One is a joint venture or a joint development agreement, where the landowner says that, let's say, this is X land of X area. We will provide you this land for the right to develop a real estate project on that land. The developer has to give certain area share or certain revenue share to these landowners. That is usually called JD or JVS, joint development agreements or joint venture agreements. I am not getting into the taxation legality on how these two are different. Our entire focus will be on the commercial aspects of these agreement. Hence, I will be using these terms interchangeably. Then there is the third kind, where a landowner comes up to you and says, okay, I want to outright sell the land and you become the owners. Why outright is different, and I have classified it as a third category, because in outright sale, the biggest investment of the real estate developer is involved, in which he has to upfront pay huge chunks of money to become legal title owner of those land parcels. Now, the fourth type, or redevelopments, are ones where the investment from real estate owner is minimal. These are old societies or SRA projects where by doing certain legal processes, by giving certain units to the old tenants, to the old owners, he gets certain free of sale FSI area, which he can sell in open market. And redevelopments are a different ballgame. So usually any proposal that comes to developer, you can broadly classify them in these 4 categories. Now, why these play a major role in our acquisition decision is, at the time of acquisition, when you are giving area share, the assessment that a finance guy or a chartered accountant needs to do for the landowner is, unless the area share that needs to go to the landowner is constructed on the right time, the title for the land is not perfected for such landowner. So whenever he is planning the project, he has to either parallelly construct the area that he plans or intends to give to the landowner, or he needs to ensure that whatever he sells, certain portion of it is taken out, created as a reserve to construct the area that he has to give to the landowner. This has a major impact on the payback within the project, the IRR of the project. Hence, area share is a different ballgame altogether. Sometimes there's a hybrid contract where you give area share to the landowners, But the landowners end up saying that the developer needs to sell that area also on their behalf. Area share also has an impact on how RERA will operate, because the entire construction cost of the entire project is incurred by you, and you get a deduction within your 70% limits that allows you to play around with more cash flow. Whereas in revenue share, it is done on principal to principal basis, where that shield might not be available. If you discuss the revenue share type of proposal, this is where developers agree on a certain minimum selling price with the landowner, agree on the fact that every square feet that they sell, whatever revenue they make, certain percentage of it will go to the landowners. Now, in outright sale, like I told you, they check the title, they become absolute landowners of those land parcels, and then they float a project on these land acquisitions. And redevelopment is where they bid with existing societies, existing tenant societies. They will give certain deposits to the existing owners. They will commit to certain rental payments month on month to the existing tenants, demolish the building, construct it, and then move the old tenants back into the new building while they are also constructing the free of sale FSI area. Earlier, if you see 5 years, 7 years, 10 years before, redevelopment projects were limited to 1 lakh square feet or 2 lakh square feet, and there was rarely an instance where you used to see 2.5 lakh square feet worth of redevelopment projects. Nowadays, the redevelopment scale has gone up to such a level that we also hear about 50 lakh square feet redevelopment area and 60 lakh square feet redevelopment area. Now, these are huge ballgame numbers where the developers have potential to earn multiples, in several multiples, if they manage their cash flow and IRR in an optimum manner. Now, these are the 4 types of proposals that you will usually see real estate developers come across. Now, the second biggest investment that they need to do, you will become the landowner or you will step in as a developer in those land parcels. But unless you make payments for approvals, your project does not get approved. Now, in India, fortunately or unfortunately, a single real estate site is covered by at least 40 to 50 different kind of laws. The majority being environment clearance, local approval laws, which will be the municipal corporation. There will be water NOC, garden NOC, sewage NOC. There will be NOCs for road acquisition, handover. There might be compulsory land acquisition by highway authority. There might be certain collectorial laws where certain agricultural land need to be first converted into non-agricultural status. Sometimes in Maharashtra specifically, there are laws where you have to pay nazranas for the land because the land comes with a historical baggage. Now, all these approval statuses, for a real estate project to be comfortably launched under the RERA regime, the entire idea is to get the approvals prior to launch. And here is where a chartered accountant can play a drastic role in changing the acquisition decision. Now, if you look, if we will be discussing a few case studies at the end of our presentation, if you look at where certain developers went wrong is, they used to evaluate the project in absolute numbers, not put at what time, how much cash flow they require and at what stage they become launch ready, and usually enter into sites and get stuck for cash flows. I can make this statement absolutely with all my experience in real estate. There has never been a real estate site that has been calculated as a loss-making site when the developer is acquiring it. It always makes sense on total basis. But whenever it came down to cash flow management, whenever it came down to approvals, whenever it came down to launching the site, whenever a certain benchmark has been crossed by our real estate clients, they have gone into losses where either overheads kill them or either the borrowed money interest loss kills them. or either they have sold at a very good rate, but because they cannot initiate construction, they cannot collect money from the customers, they have come at a standstill. And there have been enough and more cases at pan-India level, from Amrapali to now Supertech. These developers were working at a level where they used to churn 6 crore square feet every 2 years, 3 years. And from that point, coming to a level where they are now under insolvency is a shocker for all of us who follow real estate. Now, if you come at the bottom line, where these developers have failed is they have taken out money from certain projects in the anticipation of making profit or multiplying it in the other project, invested it in another project, and those projects have either got stuck for approvals or got stuck for litigation, and then the entire cash flow collapses. So why a role of a chartered accountant or a good financial manager comes into play? Understanding at what point how much cash flow will be required for making the project launch ready is now a conversation that you can have with your clients. The second bit is approval status. If you look at any working that is done by an architect, he usually gives you a total feasibility that this much fungible FSI you'll require, this much TDR you'll require, this much premium FSIs you'll need to pay. Let's say this much Nazrana you need to pay to clear the title, and you have the numbers on total basis. Now imagine evaluating two projects on approval status. You have project A that is talking about approval cost of only 20 crores and generating a turnover of 100 crores over a period of 3 years. And in the same case, you have one more project that will generate the same amount of turnover. It has, let's say, approval cost of 25 crores. And based on these two assumptions, if primarily a real estate developer is sitting on absolute number basis, he will always go with option B. But if a finance guy delves into more into facts and figures out that the 25 crores in option B is required only at the time of completion to be paid to, let's say, Mahada or premium FSIs for completion, whereas 20 crores is needed to be invested on day 0 to get approval for 100 crores, that is where the entire game plan changes. Because investing 20 crores in approval and then making the site launch ready would usually require the developer to be ready with 30 crores. Whereas in option B, if his basic approvals come in 1 crore and he can pay 25 crore, remaining 24 crores at the end of the project, he will always opt for option B, because then he can pay these approval costs out of the sales receivables. So why such points are required for evaluation and understanding IRR? This is where a deeper understanding of cash flows is required at the time of acquisition, which us as chartered accountants understand the need for cash flows, and understanding healthy margins can explain our clients and ensure that they make the right acquisitions. Now, the third point here would be refundable or non-refundable deposits or upfront consideration. These again flow from the first 4 types of proposals. Refundable deposits. Now, again, these play a huge role in our acquisition. Let's say you have to pay a certain refundable deposit to the landowner, but the refund of that deposit can be taken in 1 year of your acquisition from the landowner, or in certain cases it can be taken after 8 years. To a real estate developer who's looking at absolute terms, he's looking at refundable deposits as an absolute cash outflow. But to us, we should be able to tell him that, let's say, if you keep your refundable deposit invested in the project for 8 years, it costs you, let's say, if his borrowing cost is at 15% or 18%, it costs you 18% year on year more, and your refundable deposit actually costs you more. So you need to recover it before, so that you have a better, healthier margin or bottom line within your project. Now, this understanding comes only if you put things in a cash flow term and try to understand when inflows and outflows will happen within your project. Same thing applies to non-refundable deposits or upfront consideration. Imagine we have seen developers who come up with an option where a landowner is saying, you give us, let's say, 20 crores worth of refundable deposit and give me 34% of revenue share, or you outright buy the land from me at 120 crores and you pay me this 120 crores over 1.5 years by giving equal installments across every quarter. Now, when the developer looks at absolute terms in the project, let's say he looks at giving revenue share of, let's say, 250 crores against an absolute amount of 120 crores. And in those absolute terms, it will always make sense to go ahead with outright funds. But the moment you put it in cash flow and make him realize that when you are giving 120 crores out of your own receivables or equity, you are actually paying in 18% interest on it. And eventually, when the project gives you that payback of 120 crores, it's actually going to cost you more. In our cases where we have calculated in the same example that I am discussing with you, I can't discuss the name of the developer. We eventually ended up showing the developer that giving revenue share of 200 crores was much more feasible because the 120 crores was eventually translating into 280 crores with interest, even at aggressive sales velocity that the developer was trying to build in. So in his best case scenario, he was paying 120 crores plus interest at 280 crores. Whereas in his worst case scenario where he was doing revenue share, he would still give an absolute number because the minimum selling price was not changing. So this kind of understanding can come from chartered accountants who can actually add strategic value to a real estate developer, and he can understand acquisition in a much more depth. Now, clear title or litigation, this is another point where we as chartered accountant play a key role in making the developer understand which is the right way to go. Clear title always comes at a premium cost. So if the land is with clear title, means there can't be any delta that the real estate developer can earn for land cost, because a landowner knows that his title is clear, so he will always demand the market value. Whereas then where a land is carrying certain litigation or certain encumbrances and which require a lot of effort to clear, the land comes at a discount. Now, our job as finance guys or chartered accountants come to make him understand that the delta that he is trying to earn by clearing litigation is wiped out in the interest that he pays over the upfront money. So let's say we have seen cases where developers enter into a land saying that, see, the landowner, if the area was clear, would have sold something at 100 rupees. He's giving it to me at 60. I will pay 20 rupees to clear the litigation. So I will make a delta of 20 in land cost itself. This is how your developer entrepreneur thinks or evaluates a project. Now, our role in making them understand IRR is how much time will it take to clear that litigation? When does he have to pay the 60? When does he have to pay the 20? And whether after building in the interest and opportunity cost on clearance of that litigation, does he really make the delta of 20 or does he end up paying more? So on the discussion table, there are always options where the landowner himself says that you give me the money and I will clear the title and give you the land at 110, let's say. If you want to clear the litigation, I will give you at 60. Now, a traditional entrepreneur will always think against 110, if I am buying the land at 60, let's go ahead with it. But when you put interest to it, when you put the time factor into it and you figure out that, okay, he was asking for clear title at 110, whereas for us to do it, and even if we put conservative time frames, we eventually end up spending 120 as an opportunity cost and an interest built in. 110 suddenly becomes lucrative. Now, these principles we have already learned in our financial management. These were basics that were taught to us when we were doing our CA final or BCC. What usually happens is we forget applying these in our real life. And that is where we are not able to add strategic value to our clients. So keeping these basics as a core and then trying to figure out how each strategic decision that the developer is trying to take at acquisition, how it impacts his bottom line. If you are continuously able to add that value, you will see that more and more real estate clients will involve you at the time of acquisition, which is a different scope of practice, because at that time you not only get opportunity to do a lot of creative tax planning, but you also get opportunity to actually add strategic value to your client and become a staple in all his acquisition discussions. Now, where is the real profit in acquisition? Once we understand this, we'll be able to go to the second part of our presentation on how IRR works. The real profit in acquisition is when whatever money we invest while acquiring the land is taken out of real estate project after sales at the earliest. There's no set format. I can't tell you that, okay, when we are launching 2 lakh square feet, I need my money to come out in 9 months. That is not how things will work. What will work for us is understanding and setting a benchmark internally. And these benchmarks cannot be set by a person who does not have our kind of training as chartered accountants. So when we set these benchmarks and start guiding a real estate client around these, we will start giving more, let's say, weightage to financial decision, and the developer will actually end up making a super multiple on such acquisitions. So this was all about understanding how acquisitions work. Now let's say what clients usually do. I have touched upon this topic even during the first slide, but let's understand how traditionally acquisition works. Usually a developer has his architect identified, who, whenever a land parcel comes to them, they will look at the development plan, they will look at the town planning plans, they look at the reservations on those land based on road width, based on dimensions. They'll come up with a FSI approvable plan, calculate the built up, calculate the total saleable, and that becomes the feasibility that comes out of architect. Architects usually take a benchmark of construction cost, usually take a benchmark of overheads, and then tell the developer that, see, this is the profit you can make on the project. I can tell you with absolute assurity, there has not been a single architect who has reported that a single project will go in a loss. Because if you make any project, any real estate project in absolute terms can never make loss, unless you are going horribly wrong or the land cost is exponentially different. Usually the landowners themselves also do this calculation before approaching a developer for acquisition, so that they know the right price to charge. And because architects give them the total feasibility, the expectation of landowners is also higher, because they think, okay, developer is going to make this absolute profit without my cost, so I must get this much percentage of the profit he might make. Now, this is where the entire real estate deal making capabilities of chartered accountants come into play. If you are representing the landowner, and let's say a landowner has come to you with an architect calculation and asking you, okay, these are the workings, what is the kind of offer I should make the developer, or what is the right price for acquisition? At that time, reverse applying the case and understanding what will it cost the developer, whether he will be able to make a reasonable profit for him to be interested in the project. Because some developers might not have the experience of understanding how interest and IRR return would work. But if he goes into loss, your client as the landowner is also going to get stuck in that project. If your landowner has unrealistic expectations in the project, his deal is not going to happen. So that is where the deal making capabilities of chartered accountants comes into play, where we have to balance the cost that will be incurred. The absolute basis is irrelevant. We need to break it down into phases. We also need to calculate the time value of money for a landowner. So let's say if I am sitting at the seat of a landowner and I'm doing his evaluation, and he was to get the 34% revenue share. The question is not what 34% will translate into in a project. What we need to calculate for him is in what phases will he launch, in what velocity will he sell, and whether I will get exit in next 5 years, 7 years, 10 years, 15 years. So the 34% might translate into 300 crores. But if you are getting it across a period of 15 years, its time value of money today will not be more than 80 or 90 crores. So if he was going with outright and let's say a developer is offering him 120 crores upfront and the other developer is offering him 34% revenue share, which translates into let's say 384 or 400 crores, but the time value is 90. We will be able to advise him that okay, the outright offer is makes much more sense because you might just as well get it, pay the taxes, and then invest them productively in share market. So that is where our role comes into play. Architects do their role in giving the total feasibility, but us having the understanding on how those numbers will translate into real profits is the role that we need to play as chartered accountants. Is total potential the right way to go? This is the second folly that most of our real estate clients do. Let's say the recent changes in UDCPR rules in Maharashtra allow high-rise towers across Maharashtra. So let's say a land potential that usually would construct, let's say 12-story, 14-story tower. Now that same land parcel can construct 30-story, 35-story tower. Now, usually if you ask an entrepreneur developer, he will say, "Are same land parcel pay, I am getting, let's say what was 12 lakh square feet of saleable has jumped to 30 lakh square feet. Why won't I construct 30 lakh? Because I would make additional profit." Right? But that might not be the real scenario, because for the additional approvals, he might have to pay premium FSIs, fungible FSI, he might have to invest in TDR. He might also, what his construction cost till 12-story is, let's say 2,200. His construction cost for 30 stories is 3,000. That realization most of the times comes out of a chartered accountant. And that is where we apply our concept of marginal profits. Whether the additional floors is translating into real additional profits. The second bit is he would complete the 12 to 14 story tower in, let's say, 24 to 36 months of period. But when he is constructing 30-story towers, it's a different ballgame. He will require 4 to 5 years. He'll require different kind of technology where he'll have to use precast or aluform or some specialized contractors, specialized cranes to reach that height. So something that he would have realized in 24 months, in best case scenario, he will realize in 48 months. Now building time factor into it and making him realize that even when you go with the lower potential, you actually make more profits or equal profits. That test of profit and time value of money needs to be done by us chartered accountants when such a client comes to us. Because an architect will never give you lower potential unless you ask him that can we eliminate premium FSI? What is the basic FSI? What is the kind of approval we can take without paying any premiums? Even in the premiums, we have certain categories. So if you go higher, your premium FSI based on ready reckoner also goes higher. So there might be certain permutation where between 14-story and 30-story, 21 stories is the optimum size. For us to help our client to reach that, don't build entire potential, but don't even build basic potential, 21 story is the right call. That cannot be added value strategically unless you run those numbers on certain Excel models that you construct and you apply your own logic. A real estate team will be able to give you the construction cost, but they may or may not be able to give you time value of money, and that is where we as chartered accountants can add a lot of value. Now the third point also talks about whether total saleable into total price less total cost, is it the real profit? What is the timing of that profit? All that is usually skipped by our clients, and if we can add value there, that is where we can actually give a different perspective to our clients. I would love to answer any questions that anyone might have at this stage, because next we will go into how we will add value to the project. Salim sir, any questions that have come up?
So there are no questions as of now. Usually, when we send across the the invites, we always tell the participants that questions would come towards the end. So maybe that's the reason there are no questions that has come till now. So I would suggest you could continue further, sir, and take the session ahead.
Absolutely, sir. I hope at least I am not boring you.
Sir, come on, not at all.
All these
in fact, after hearing you, I have a question in mind, but I've reserved it for last. I have a couple of questions in mind.
I'd love to answer those. The entire idea is I have designed this presentation to share my practical experiences, to direct our participants towards more practical aspect of working in real estate rather than just concentrating on formulas or how things work. So the idea is to ensure that we start thinking in this direction, and the moment we start adding strategic value to our clients, that is where the clients pay top dollar, because they know when they come to your office, they are going to get something more than just mere cash flow calculation or mere project calculation for raising funds. That's not where we really add strategic value to a client, and that is where this entire presentation is aimed at. Now, where does IRR come into play? Like I've told you in previous slides, what we usually see is between outright deal and JV deals. Unless we compare the cost of acquisition of outright deal to the timing of payment in JV deals, the developer will not understand whether what is the profit he's trying to make. Now, there are certain developers who are one-time developers who are flush with equity, who are flush with liquidity, and they would say outright deal is always the best deal because they carry no risk at all. That is not true. What experience has taught most developers is outright deals also carry the same title risk as JVs carry. What I mean by title risk, the previous skepticism towards joint venture was because we are married to the landowner till the point the last building is completed or last rupee is paid, there's always a risk of a litigation popping up and stopping the project. That would stall the project, bring in multiple litigation, and the risk of litigation is higher in JVs. What we have learned with our experiences, even when you do outright deal, it's virtually impossible to eliminate all kinds of litigation. So sometimes you will have a boundary dispute with your neighboring plot owner. Sometimes some new owner of land will pop up saying that, let's say, a sister or a family member or a divorced family line had certain share of the land, and you carry the same kind of title risk. So this misconception that the developers had, that outright is much more safer than JV, this misconception is slowly diluting. They are realizing that outright deals are as safe as JVs, or JVs are as safe as outright deals. So if both are kept on equal pedestal, then which is the way to go? Now, this question cannot be answered by an advocate, because he will look at the title and provide you the security that the title is perfect, whichever direction you go to. This again cannot be answered by an architect involved in calculating the feasibility. So this boils down to the gut of the entrepreneur or a finance guy proving in money terms which direction to go to. Now, this plays a huge role in our IRR calculation, because in JV you might end up paying, let's say, 10% of your outright deal cost as deposits to the landowner. And let's say if you have the same 120 crores to give in outright deal, and you start the JV with the same 120 crores, your 10 crores goes in, let's say, the deposits, your rest 25 crores goes in approvals, you still have, let's say, 60 to 70 crores available to you to work with as construction finance, and you might not borrow from a banker and construct the entire project debt free. That's the kind of freedom that you might end up exercising if you go with a JV. But the risk, again, the title of the land is not perfect till you pay the last money to the landowner. So these kind of decisions play a huge factor in our IRR calculation. Now, when I say factor in IRR, it is not just the timing bit. You will also be able to understand the risk factor or the interest rate that you need to use while calculating that IRR. So let's say a developer might say outright is lower, carries lower risk than JV. So you will use a higher discounting rate in JV and lower discounting rate in outright. Now, that understanding comes by understanding the on-ground situation per site. There's no straitjacket approach to it. Then the second bit is whether upfront payment versus delayed payment. You also get deals where for evaluation where the developer comes up, I want to do outright deal, but the landowner is telling us that, let's say, you pay X in first 6 months or you pay X plus plus in 24 months. Now there you won't only look at the interest calculation. There is no straitjacket approach. You will have to add the risk of unpaid consideration while calculating the deferred payment option. Further, whether you are paying the upfront payment and delayed payments from your own equity or whether you are generating it from the cash flows that would be generated from the project itself. Now, I can give you n number of examples where developers have gone wrong. They have taken the deferred payment option. They have assumed that they will achieve certain sales by certain month. Those months have come up, but certain approvals have not come, or they have launched, but they have not received the response that they had assumed. And then they start defaulting on all fronts. They start defaulting on approvals, they start defaulting on landowner payments, and their entire investment gets stuck. Now, unless a financial expert applies a risk to all these factors and gives them a weighted average in number terms, let's see, you're carrying this kind of risk if you go with this kind of situation, that will not add value to the developer. So for us to add value to our client and help him in that strategic decision, every factor that he has negotiated in the term sheet or he is going to negotiate has an impact on our IRR calculation, and that's what we need to understand and absorb while doing this evaluation for our clients. Now, whether the capital that we have, most developers have limited capital. No one comes to the discussion table saying that I have unlimited capital to do a project. So everyone starts with the statement that I have 5 crores, 10 crores, 15 crores, and I want to do this project. So some of them might say ki I have 15 crores, then the landowner is also asking for only 10 crores. So let me enter this site. And some of them may say that I will invest my entire 15 crores in land acquisition. There is where our role comes into play, where we populate the entire cash flow, understand from the architect when he requires what amount for approvals. And if the developer is not able to bring in the further money for approvals, or he is not able to launch, no banker invests nowadays in greenfield project. It's very rare that they enter at land stage. So NBFCs, even equity funds have dried up, and today's market is only working capital market. So the earlier assumption the developers used to have that once I enter the land, I'll get a loan on it. That is not true. The risk profile for developers has changed, and bankers have started investing only in projects which have 100% approvals. Now, if he's not able to get 100% approval, and if he has invested all his capital in acquiring the land and paying stamp duty for it, he will end up in a cash flow crunch and enter into a debt trap where he'll borrow from private lenders, then get into a loop where he has to sell, collect, and repay the private lenders first before he starts construction. And that is where the real estate sites start failing. So why I'm bringing this topic up and why I want our members to appreciate this analysis is unless we factor that in and we are able to tell a entrepreneur that, see, this is where you can go wrong, and if you have 15 crores, look for land parcel where you invest only 8 and keep 8 for working capital. This understanding, unless a chartered accountant is able to give his clients, it is most likely that he will commit a mistake in buying those making those buy-ins and making the right business calls. Same thing happens. We discussed how approvals matter, whether to go between to 30 floors or whether to stop at 21 or 12. All those discussions come out of numbers that you run on draft models. Previously, this used to be post facto. So developer used to acquire the site, and then chartered accountants used to come into play, and they used to make a project report, submit it to bankers, and answer those questions, where these guys have already invested their money in the project. So they had to, the only option they had was to channel through. But now developers have learned that before acquisition, if these models can be run by intelligent chartered accountants who give them that strategic insight, they can actually save a lot of money. And that is where we can add value to our clients' acquisitions. Commercial tower versus residential towers. This is a perpetual debate that you will have with your clients. Most clients end up saying that my project is located on the main road, so I want to construct showrooms and offices, and residential only gives me X rate, whereas commercial gives me Y rate, which always is 1,000 square feet or 2,000 rupees per square feet of delta. So they always want to lead towards commercial tower. But what we need to bring to the table and tell the developers is a commercial tower will never get sold unless the RCC of the project is complete. Unless the building is standing there, the customers do not buy those units. Whereas residential, they buy even at conceptual stage where you just construct plinth and sample flat. Now, this timing difference of, let's say it's a 14-story tower, residential tower money, 70% will be in a 14-story tower will be collected within first 12 months of the project. Whereas a commercial tower, maximum money will come at the fag end. Now that 2,000 that he was trying to make a delta of might get wiped off with the interest that he will pay to construct the commercial tower. So no matter what is the location, unless he is able to make enough delta for constructing a commercial tower, he will end up losing money rather than making money. In absolute terms, commercial tower will always make more sense than a residential tower. But unless you put time factor within that analysis and make the client realize that, see, the timing of realization of money is very different. Bankers give loan for under construction residential property, but in commercial, most bankers shy away from disbursing under construction commercial towers. Now, all this translates into late money to our clients. Late money means interest loss. Interest loss means lesser profit. The moment we are able to communicate this intelligently in number terms to our client, I think we can add more value to it. Low price, high velocity game. This is another aspect where a finance guy can play a great role. Now, most sales heads of real estate teams will tell you that they would require a lower rate for sale to get high velocity. And most entrepreneurs or developers will tell you that my competitor is selling at X rate. I am a better brand, so I need to get at least X plus 5%. Now, the moment you are able to put it in a model term and explain your client that for charging that 5% premium, you are sacrificing 6 months of velocity, or let's say what could be sold in 3 months, you are extending it to 24 months. Unless you put it in numbers and make him realize what is the kind of cash flow he is letting go, he will never give a rate that is the best rate for selling his project. Very rarely you find developers who understand this language from the get-go, and they don't need chartered accountants to explain this. But for developers who are first-time developers or people who are doing first-time projects, giving this insight and letting them know that getting a premium of 5% is not affordable, because if you sell it 5% lower, you take exit within first 3 months. I have seen projects where in absolute terms, clients have let go of crores of rupees, but they have generated IRR of 300 and 400% because they invested money 3 months ago and they took out their capital within 6 months and also took out 80% of their profit. That generates a huge IRR. Imagine the project going into auto mode, only 20% of profits are reinvested. You have taken out your capital, you have taken out 80% of projected profit. And now the project is in auto mode where your engineer is constructing, your accountant is paying regularly, and you are out. But that cannot happen unless all sales are done. You can sit on that inventory, but then you have to continuously plan for the cash flows that will be required to construct the site. Now, these kind of insights are very important, and this is where IRR really comes into play. To sum up, where is the role of chartered accountants in making this right decision? They need to make the client understand time value of money. They need to make them understand there is a risk to scale and not economies to scale. We have been taught this basic that economies of scale is always great. So bigger the project, better the economies. But the cost of that economies is the risk of scale. Doing a township versus doing a 14 lakh or a 15 lakh square feet project, both carry different risks. In township, your construction cost might be lower, but your overhead and interest cost might be higher. Making them understanding this risk of scale is the biggest role that we can play. More time is equal to more risk. This is a learning that has come out of COVID, and this we need to translate to our clients. Whichever project which had long drawn delivery periods during COVID, once they stopped, picking up sales, picking up construction became a huge problem, and even good brands have gone under during that period. Whereas developers who are doing smaller projects, even COVID could not stop them, because those 1-2 building projects, they could push through their own equity and ensure they continued delivery even during COVID. So more time is equal to more risk. This is the understanding that we need to translate to our customer. Impact of debt on promoter fund. This is something that we have discussed in depth today. And the right potential for use from feasibility stage. Prior to acquisition, making him realize that this is the right configuration that you need to construct. You don't need to go high rise, you don't need to go low rise. You might end up just constructing a bungalow project and making the same profit. Bungalow project you will exit in 1 year, but you will make the same profits. Making them realize all these permutations becomes a possibility that chartered accountants need to bring on the table. And that is where I think we can help them make the right decisions. Now, there are a few examples that I wanted to discuss. I have given you a few names. Even if you Google these, you will find positive and negative reviews about both. Now, I won't, because this is an open forum and I don't want to classify who's doing good or who's doing bad. But I'll tell you that once you go in depth in these cases, you will realize that some developer who has acquired huge land parcel historically in Thane has taken out all his earlier investment and now is capitalizing and making 10 times the profit that he had assumed earlier by ensuring that he launches projects in smaller bulks, keeps on selling, and created an entire town in a Mumbai pocket. Whereas there were developers of Noida who have kept on reinvesting their profits without actually closing their ongoing obligations, and they have gone under. Then there are smaller players who have stuck to their own cities but generated the same multiples that developers working pan-India have been generating. Each one has figured out the power of IRR in my understanding, and the double-edged sword that IRR is. That unless you pay attention to it, real estate developers cannot survive. So there have been players who were the top 5, top 4 player at a certain point of time 10 years ago, and suddenly they have lost and you don't even hear their name after 10 years. This has happened because they have made a wrong investment where their monies have got stuck. And the moment they get stuck, coming out of that loop becomes very difficult. And us as chartered accountants have the biggest role and in raising that red flag during acquisition itself, so that they can generate the multiples that they can. So this was my presentation. I would love to answer if any queries are there. Sir, over to you.
This went very smoothly. We understood everything. For information of all the participants and you, we have got CA Dr. Rajkumar Adukia, sir, Chairman of Committee on Economic Commercial Laws and Economic Advisory. And I would love to describe him like he's passionate about passion and he's driving people around and he's doing immense work for the fraternity. Trust me, always the call is that how fraternity should benefit, whether it is from these programs, it is from the certification programs, it's getting queries from them, resolving them, and for him nothing is minute. He attends everything with the same zest. So I'll just take a minute and then all to you, sir. CA Dr. Rajkumar Adukia is a BCom, he's FCA, he's FCS, FCMA, he's a law graduate, MBA, as well as MCom. He has diploma in IRR from UK. He is also having a PhD in IP from IBBI. He is involved with UNODC, which stands for United Nations Office Drugs and Crime, and he has also got the accreditations and the certifications on anti-corruption, prevention of corruption. He's serving ICI since 1998. He has a track record of doing immense work for the fraternity of the ICI. He has more than 37 years of experience to his career. He has served as president of GST Research Foundation. He is the chairman of Association of Indian Investors.
Thank you, Dr. Salim. Thank you, Dr. Salim.
So welcome you, sir. So we welcome.
Thank you. I think the biggest beneficiary of all this exercise is myself. And therefore this passion, like I joined when C.A. Saransh was speaking, how to invest in real estate. And the IRR, the use of IRR in the business, the miracle which can do. And similarly, C.R. Venkat Subramani, he spoke about, a very small part receivables, which is very, very important in Schedule 3. And Mr. Jiten, who was assisted us in moderating. So I invite all the viewers, and I'm very passionate to mentor them to be a speaker, to be a writer, to be a moderator. The institute pays 500 rupees per page. So if one writes 100 pages, that is the best way to enhance a practice in a particular passionate area. So you don't have to do anything. You are earning, you are learning, you are getting connected to all experts in that particular subject. So please come forward in various our activities. We have a webinar tomorrow, the two topics. When on Sunday, there are two days. One is an international day called Labor Day, and another is a national day, which is a RERA day, because RERA got implemented from 1st May 2016. So we have two webinars on that, and then every day we have a webinar, and some days we have two webinars. So please come forward and sign out. जो दिखता है वो बिकता है. There is a concept which is very old, but which has become more popular now. Be a thought leader. So when you speak out like Saransh, I have heard him earlier. He is a thought leader on real estate industries. He is passionate about how real estate industries, we go beyond income tax, GST, accounting, and then he is really talking about the industry, how one can make profit in the industry, how one should invest. So we are the whole entrepreneur guide. We are CBA rather than CA, Complete Business Advisor. So I wish you good luck. And then over to Dr. Salim if there are any technical query for CA Saransh.
As of now, there are no questions.
Akash can support us, Krishnakant can support us if there are queries in chat box.
No, sir, there is no query.
Great. So the faculty was so nice that subject become very crystal clear and no queries. So thank you. We end the webinar and look forward to see you at 4 p.m. tomorrow for another 2 very interesting subjects, Schedule 3, CARO, and very interesting subject on customs law. Thank you. We end the webinar.
Thank you, sir. Thank you.
Thank you.